Uranium. It's a buzzword that immediately triggers thoughts of danger, disaster, and doomsday headlines. And for most people, the association stops at nuclear power plants and radioactive waste. But here's the twist. Uranium isn't just a headline grabber. It's also a legit commodity that you can actually trade. Now, this often misunderstood element plays a serious role in the global energy markets, and savvy investors are already paying attention. Now, in this video, we're going to break it all down for you. We're going to talk about what uranium is, how it's traded, and what you need to know if you're thinking about jumping into this high volatility, high potential market. Okay, let's do it. Uranium is a heavy metal with the atomic number 92 on the periodic table. It's naturally radioactive, dense, and silvery gray in appearance, and it's found in small amounts in rock, soil, and water. Now, industrially, uranium is the backbone of nuclear power generation. In fact, over 90% of the world's uranium demand is tied directly to fueling nuclear reactors for electricity production. On the military front, enriched uranium is used in nuclear weapons and submarine propulsion systems, making it a key component of national defense strategies. Uranium also has medicinal applications. Certain isotopes derived from uranium are used in cancer treatments and medical imaging, proving that even radioactive materials can have life-saving benefits when they're handled properly. There are three big reasons why global demand for uranium is poised to surge in the coming years. Number one, nuclear energy is making a major comeback. With the world urgently searching for clean, reliable alternatives to fossil fuels to power things like AI, countries like China, India, and several others across Asia are going all in on nuclear power. Dozens of reactors are already under construction, and many more are in the planning pipeline. All right, second, the uranium supply is tight. Just three countries, Kazakhstan, Canada, and Australia, account for about 2/3 of global uranium production. Any disruptions in those regions can send shockwaves through the market. Lastly, the uranium market isn't just shaped by supply and demand. It's also heavily influenced by investors, hedge funds, and even governments that are stockpiling uranium reserves. This speculation can send prices soaring with very little warning. Now, if you're looking to get in on the action, here are 4 ways that you can trade uranium. All right, one of the most basic ways to trade uranium is to simply buy a uranium company, somebody that's involved in that uranium value chain. These could be miners, these could be folks in exploration or any sort of cultivation of uranium itself. Now, that's going to be the core business behind these companies, and you can see that there's quite a few big names here. One of the ones that we're looking at right here is going to be Cameco Corporation out of Canada. That's probably the largest North American producer of uranium and really a major player on the global stage. Now, there's a couple of benefits to trading uranium companies. Number one, typically you're involved in a cash type of a deal. You're going to buy shares of stock, and that's going to enable you to hold those into perpetuity as opposed to some derivatives products like futures or CFDs we're going to talk about in just a minute, where you're going to have expiration dates and you're going to have rollover fees and things like that. It's very simple to trade uranium companies, but the biggest challenge that you have with it is a lot of times these companies, they don't reflect the actual price of uranium. So while uranium may actually be going up, their core business may be struggling because of balance sheet issues, because of credit issues, or any number of things that can really hurt corporate performance in the commodity sector. So the simplest way to trade uranium is just to buy uranium companies and look for a little bit of value there. Remember, you can hold these longer, typically a cash deal, so you're not really going to get overextended. You can trade them on margin, but a lot of times that's going to depend on your arrangement with your broker, and that can be capital intensive. So there's a lot of other ways to trade uranium that are more direct. This is definitely an indirect way of capitalizing in on the market and trading the uranium market, but it is a good introductory into the sector itself. So the first way, and probably the easiest way, is just to buy uranium companies. One of the easiest ways to get exposure to uranium is through ETFs, exchange traded funds. Now, these are investment funds that trade on stock exchanges just like regular stocks, but they're designed to track the price of uranium or the performance of uranium related companies. Some uranium ETFs hold shares of mining companies, while others track the spot price of uranium itself. Popular options include the Global X Uranium ETF and the Sprott Uranium Miners ETF. These ETFs offer diversified exposure to the uranium sector without the complexity of dealing with physical uranium or individual stocks. If you want to ride the uranium wave without the risk of picking a commodity or individual stock yourself, then an ETF may be the way to go. Another way that you can trade uranium is through a futures contract. Now, this one's listed on the Chicago Mercantile Exchange, or CME, and it's the UXC Uranium U308. Now, what does all that mean? We don't really need to know what it means. We just know that we're trading uranium, and this is a uranium futures contract. Now, remember, these are derivatives products, so there is going to be margin requirements involved, and everything is going to be leveraged. It's a lot like CFDs. We're going to talk about that in just a second. But this is the contract you can trade. The symbol is UX. UX on the CME. And let's take a look at some of the contract specs. You can see that one contract deals with 250 pounds of uranium. The price quotation is in US dollars and cents per pound. Trading hours are the same as some of the other CME group products. Minimum price fluctuation, 0.05 per pound. That's 5 cents a pound. And that 5 cents is going to equal what? About $12.50 per tick. So a tick size is going to be 0.05, and you're also going to have a $12.50 tick. That's a pretty good size contract. And you'll see right there your product codes are UX, and UX. So that's what you'd be looking for on the futures contract. One of the great things about futures is you don't need a tremendous amount of money to take positions on a futures contract, and you can make your profits significantly larger, or you can make your losses significantly larger according to that capital efficiency. So you can control much larger positions than maybe you should. That's why it's absolutely imperative that you have a proper discipline when you're trading futures. Now, when you take a look at this contract, the first thing that jumps off the chart is what kind of volume are we looking at? Well, I mean, we are listed for about 60 months in advance. So as you can see, some of the more current contracts, not a tremendous amount of volume here. Now that'll typically pick up during the trading day, but this is one of those futures markets that's relatively thin. So you need to be careful when you're trading it. Get in there when there's a little bit of participation. When these markets are too thin, price will jump all over the chart. And right over here, you can see our continuation contract for that UX, and that gives us a good look on the weekly price fluctuations with our 920 EMA crossover strategy there. So that's another way that you can trade uranium. That's via futures contracts listed on the CME. That's the UX symbol. That'll get you up and running with uranium. All right, let's take a look at another way to trade it. Uranium CFDs, or contracts for difference, allow you to speculate on the price of uranium without owning the actual asset. Now with a CFD, you're essentially betting on whether price will go up or down. This makes it a flexible option for traders who want to capitalize on short-term movements in the uranium market. CFDs can be leveraged, meaning that you can control a much larger position with a smaller amount of capital, but that also means higher risk. They're typically offered through online trading platforms and are best suited for experienced traders who understand market volatility and risk management. Ready to take your uranium trading to the next level? Trade with Switch Markets, where you get more instruments with better trading conditions, including uranium CFDs. Switch Markets gives you the tools, the speed, and the pricing to make your strategy count. Trade thousands of markets around the globe, smarter, faster, more efficiently with Switch Markets. Uranium assets can be a powerful addition to a diversified portfolio. With nuclear energy gaining momentum, government policies leaning in favor of alternative energy sources, and supply remaining extremely tight, the outlook for uranium from 2025 into the future looks pretty bullish. But let's keep it real. This market has its risks. Nuclear accidents, policy reversals, or global sentiment shifts can tank prices in a flash. One more thing. Uranium markets are smaller and less liquid compared to giants like crude oil or gold. That means sudden volatility is always possible. Now, like any commodity, uranium is best traded as part of a balanced, well thought out portfolio. All right, that's it for now. Don't forget to like, subscribe, and turn on those notifications, and we'll catch you on the next one.